Hello and good morning. Happy Saturday to all you that are watching here from the comfort of your living room. Hopefully, still in your pajamas. I may or may not be in my pajamas, but who cares? So, the point of today's webinar is to teach and help you guys get on the right path of home ownership. So, whether you've already tried this before, or this is the first time, or you own multiple homes and you're trying to get the next one, this is the perfect spot for you to be because we're going to give you data. There's going to be a live question and answer. So we have a chat box right there, which I'll drop a message in just so you guys can see that it works. I'm going to go ahead and drop in my phone number. If you guys have any questions, just shoot me a text, give me a call. More than happy to help. The name of the game here is buying a house in 2026. So let's get started. What you're going to learn today are the do's and the do nots. Okay. And I think the do nots become to be more important because the do's a lot of times are obvious, which are have good credit, which are make good money, save money, all that stuff. But the do nots can sometimes be a little vague. Donna's doing it. What's up, Dohan? How you doing? How you been? So today we're going to cover a few things about buying a house. We're not going to be here for a long time. We're only here for a good time. So when it comes to buying a house, there's three legs to a loan. Very easy, very simple. Income, assets. Okay. So income is clearly what you make, per month, per week. That could be earned income, meaning you have a job. It could be retirement. It could be Social Security, a number of different ways that you receive money. Assets are the money you have in the bank or investment accounts or other houses or things that you own that are worth money. And then the third one is credit. Okay. Everyone's pretty familiar with credit. The challenge with credit is understanding it and, do I qualify based on my current credit standings? Now, when it comes to income, let's start there. Okay, guys, you need 2 years work history in order to buy a house. What's 2 years? What does that mean? Well, if you've worked there for 2 years seamlessly or 5, 10, 20, you've hit that mark. But what if you worked 1 year at Amazon and 1 year at Walmart? Does that count? Yes, it does. What if there's 3 jobs there? It still counts. All we're doing is tying together that you've been employed for 2 years or more, even if there's gaps. Let me give you a for instance. Let's say you were working at ABC company for a year and they went out of business, so you lost your job. And now you've been out of a job for 3 months. But now you're at DEF company and you've been there for a year. Although you have a 3-month gap, there's 1 year at ABC, 1 year at DEF. Put them together, 2 years, guys. It's very easy, very simple. Don't overthink it. Okay. Never overthink it. If you can basically put together that you've been working or had employment for 2 years or more, you're good to go. Now, let me give you a little loophole because a lot of people figure I spent 4, 6, 10 years in college. I put a lot of time into school. Now I got to wait 2 more years to buy a house. The answer is no. So here's how it works. As long as you've got a 4-year degree, bachelor's, master's, doctorate, minimum of the 4-year degree of a bachelor's, and you can prove that the schooling that you had led directly to the employment that you now have a 2-year work history because school counts as work history. So let's just say you went to school to be an engineer, okay? And now you're an engineer at, I don't know, General Dynamics. I don't even know if they're around anymore. The day that you get your first paycheck stub, you can close on a house. So when you get a job, guys, especially when you're leaving college and you're getting a career, many times your employer will give you what they call an offer letter, okay? That offer letter lets you know how much money you're going to be guaranteed for the most part from this company. Many times it's salary, sometimes it's hourly, but even if it's hourly, they let you know how many hours you're going to be guaranteed per week, which we can math that out. And that's a solid income that you guys can provide us. And then literally your first paycheck that you receive, you can own a home. That easy, okay? Now, when it comes to work history, there's other things that can parlay into it as well. So if you do have this circumstance, ask the question. We'll answer it. If you want to talk about it, I put my phone number in the chat. Give us a call. Text us. Remember, this is just to give you data, get you on the right path to buying a house. Let's go to the next leg of the loan. So we talked about income. Let's talk about assets now. Okay, let's talk about assets. Why do you need assets? Well, for the best loans in the market, you do need a down payment. Okay, that down payment can range from as low as 3% all the way up to as much as you want to put down. Okay, there's no max on a down payment. If you want to put 50%, 60%, 70%, as long as the loan makes sense, you can put as much money as you want down. Now, a lot of people have different sources of assets. One of the most popular that I get questions on are, can I use my 401k? And the answer is yes. For the rest of you, what's a 401k? Well, when you work at a company or a job, and sometimes there's self-directed 401ks, it's an investment vehicle where you can slide money into pre-tax and then access that retirement. So basically, you're building your own pension, okay? And 401ks are all managed by different companies. So provided, depending on the company, you can access certain percentages. For the most part, rule of thumb, about 50%. So if you have $20,000 in a 401k, you can take that and put it into, or 10,000 of that and put that into a house. Now, here's the good news. 401ks grow as long as the market's doing well. Okay. And that's the purpose of doing these accounts, so that you have more money when you retire. So you fund it with, let's say, $100,000. Hopefully it's worth $200,000, $300,000, $500,000 by the time it goes to retire. So all you're doing, now think about this. How much did houses cost 20 years ago? Okay. 20 years ago, how much did houses cost on average? So I would say for a regular 3-bedroom, 2-bath house, you're in the neighborhood of about 300 grand. Okay. So $300,000. How much is those houses worth today? And I'm thinking about specific areas. This isn't the same across the country, but that same house is probably worth around $600,000-$700,000 today. Okay. So in that scenario, the money has doubled. So your $10,000 investment is still growing by putting it into real estate, and that's why it's allowed. Does that make sense? I hope that helps. Okay. Now, your assets can come from a number of places. It can come from stocks, bonds, IRAs, 401ks, your savings account. It can come in the form of a gift. So if it's your grandparents that are giving you the money, if it's mom and dad, brother, sister that are giving you the money, that can happen. And then here's a weird one, but it's allowed. If your employer gives you money, you can use that as a gift towards buying a house. Sounds a little strange, but there are a lot of small businesses out there where the boss man or boss lady are saying, hey, man, you've been a great employee to me for the past 10, 15 years. Here's a $20,000 out of nowhere bonus. Congratulations, buy yourself a house. So it's not very common, but it happens. There's good people out there, guys. There are good people. So when it comes to assets, that's what we're talking about. If there's any confusion here, light up that chat box. I'll be more than happy to answer all your questions, comments, concerns moving forward. Let's talk about the third leg. We're going to talk about credits. Okay, guys? Credits. The thing that many of us dread because credit is so hard to understand. You go to your phone apps like Credit Karma. Maybe you have like Credit Wise on your credit cards, and they're giving you these different credit scores, and they're all over the place. Okay. And sometimes they're really great. You're in the 700s, you're in the 800s. And then you come to a person like me who does home loans. All of a sudden, your scores aren't as high. And why is that? Why, what's the deal here when it comes to credit? Well, here's what it is, guys. For mortgages, we use a certain algorithm. Okay. We use FICO 5. Okay. And that's subject to change down the road because as tech changes, those models change. But we use FICO 5. For the most part, the credit card apps that you're using, Credit Karma, those types of things, are using FICO Model 8. Okay. For the most part. Not everyone uses the same one, but for the most part, which is a different type of algorithm on how they weigh credit, which is going to equate to a different credit score when you access them. Okay. And that sucks. I know it does. It's not something that you guys are happy about because you want to rely on the data that you receive as truth, and it's different all over the place. It's different for credit cards. It's different for houses. It's different for cars. So the financing is different. Your credit score is going to be different. Okay. But here's the good news. If your credit is good, okay, so here's what we call good credit, 660 and above. If you got 660 and above, you have good credit. If you have somewhere between a 620 and a 660, you have workable credit. If you have below a 620, let's say a 580 to 620, you have challenging credit. Below a 580 is probably going to need some help. Okay. So know that. So everybody's idea of good credit's different too, because a lot of people know that credit can go to 850. Okay. 850 is the highest score. Very rare in my career have I seen 850s, but I've seen a handful of them. So it's not really a thing to shoot for. And the difference between a 780 and an 850 is nothing. Okay. Maybe it's just street cred and bragging rights. That's about it. Okay. Thanks, Donna, for the love. Yes, share, like, all that stuff. Thank you, Dohan. So when it comes to credit, know this. As long as you have a good history, okay, I don't care if you have a 580 or an 800, as long as you have a solid history of paying your debts on time for the past 12 to 24 months. If you're way beyond that, you're golden. Don't even worry about that. But I know a lot of people hit hard times in their life. I know sometimes you have setbacks. Sometimes you get hit out of nowhere with a bill or a circumstance, and many times your credit takes a hit because of it. Okay. I understand that. That's life. That happens to many of us. I would say 7 out of 10 of people that come in, to inquire about a mortgage have had challenges in their life. Okay. A very small percentage of people don't have challenges. So know this. Don't be embarrassed. Don't be shy. We've heard it all. We're kind of like the doctor of the loan. So when you go to the doctor, you don't hold back. You tell them exactly where you itch or where the problem is. Same thing when it comes to home loans. Okay, guys. We know that there's challenges. We know that people have challenges. And if we're able to get you qualified, we will. If not, we're going to figure out what your challenge is, identify it, share it with you, and teach you how to overcome it so that you can get a house down the road. Okay. So credit, let's go back to credit. There are different programs. Okay. There's down payment assistance programs. There's first-time homebuyer programs. There's, you might hear of them. They're kind of bundled into other names, but teacher programs, police officer programs, fireman programs, all of these specialty programs do have a minimum credit score in order to access it. Okay. And when you're accessing, could be a better scenario, better terms, possibly down payment assistance, possibly money to help you with closing costs, that type of stuff. For those programs, you do need a minimum across the board of a 660 credit score. Some of them dip down to a 640. Some of them are a 680. But for the most part, to access most of them, you're looking at a 660 or better credit score. If you're just looking for you have your own down payment, minimum 3%, you're able to get in, we can work with the 580 or better, okay? But let me give you some data that just came out that may make you want to look into getting a house sooner than you think. And it's the Fannie Mae guideline change, okay? When you're buying a house, there's four major places that you're getting a loan. It's either Fannie, Freddie, VA, or FHA, okay? Fannie, Freddie are conventional, okay? These allow you 3 to 20% down on average. You can put more, like I said, if you want. VA is meant for our military men and women that are either currently serving or have an honorable discharge. And then FHA is one of my favorites. FHA is one of my favorites. And the reason why is because when people say they can't get a loan, I'm usually able to make it work FHA. So those that believe that they've talked to somebody already, went to get help to buy a house, been turned down, they come to me, kind of with defeated a little, and then I walk them through their application. We have some questions, we talk about it, and then sometimes I'm able to get them approved when they didn't think they were possible to do that because they were already turned down. And that's why I love FHA. More lenient on the credit, more lenient on the amount of debt you have, that type of stuff. Anyway, I digress. We're going to talk about Fannie Mae, the very first one that I had brought up. What they said recently, and I think it was as late or early as November 15th, they said we no longer have a minimum credit score. We no longer have a minimum credit score. Let me say that again. We no longer have a minimum credit score. So what that means is if you do have a 500 credit score, 550, a challenging credit score, there's an opportunity for you to get a loan. But you must have had your payments on time. At least majority of them, guys. Because, hard times, we have them. Irresponsibility, different game. If you're just being irresponsible, they know this. They know this by the way you operate on your credit. But those that have had hard times, they know this too. Why? Because it shows a pattern in your credit. In 2020, 2021, 2022, we see that, you've had hits to your credit, lates, 30-day lates, 60-day lates, 90-day lates. But then in 24, you saw it up. 25, you maintained it. Now that we're in 2026, you're still making payments on time. That's someone that's had hard times. That's not someone who lives irresponsibly. Okay, that's someone who lives responsibly. Now, how do you identify the person who lives irresponsibly? Because they were late in 2020 and they're still late today. It's 6 years ago, guys. You mean to tell me that you haven't gotten your stuff together in 6 years? That's the difference between a 25-year-old and a 31-year-old. That's a lot of time, guys. That's the difference between a 14-year-old and a 20-year-old. There's a lot that you can do to change things in that time period. 6 years is a good amount of time, guys. Now, if you're the person that's down on their luck all the time, you might want to look into a career change. You might want to talk with someone like me who can help you, figure things out when it comes to your finances, because the name of the game for us, guys, is that we want to do more home loans. We want to help people get more houses. We want to put more people in homes year after year. And the only way we can do that is by taking the people that are already ready, put them into houses, and then take the people that have had challenges and then help them make the corrections and then set them down on the right path so they can get the house in the near future. Now, here's what that looks like. Let me be realistic with you. So someone came to me not long ago with a 430 credit score. Okay, 430. That's a low credit score. That's a hard hit credit score. That's someone who's stopped paying bills. They had collectors chasing them, mounds of collections, lots of debt, some charge-offs, all this stuff, right? Just challenges. Said, you know what, I got a better job now. I'm able to pay my bills. All that stuff's behind me, but it's still sitting on my credit and it's destroying my credit score. So we put him into credit repair. 6 months later, this person's credit score went from a 430 to a 660. 430 to a 230 points it went up in 6 months. Okay. Now think about how fast 6 months is, guys. We're going to be in summertime in no time. We're going to blink a couple times and be at summer. So this person could potentially start today with this type of credit, get into credit repair. And yes, I have someone that I can refer you to. And then by summertime, be shopping for the home of their dreams. And guess what? When do people shop for houses most of the time? Summer. Or let's say the circumstance gets pushed to summertime and they don't get started till summertime. Well, they're in their house by Christmas time. That's how fast 6 months is, guys. And think about how long you've been sitting in that bad credit. Think about how long you've been down on yourself because your credit sucks. Months, years, decades for some of you. And you mean to tell me you might be able to turn this around in 6 months? Holy cow, why wouldn't you do that? You mean this could be the difference between you owning a house and not owning a house? Why wouldn't you do that? That's insane. Okay, so if you need help with that, we can help you. These are credit specialist people. This is not something that I do. We can do lower level stuff, which is like credit simulators. Like, let's say we're trying to bump you 10 to 80 points. Yeah, we can work with that. Okay, but repair your credit, different game. Because some people that have high scores or higher scores and a lot of baggage behind them from their past history still can't get houses. Every scenario is different, guys. Every scenario is different. So I'm telling you what not to do. These are the things not to do. So if you're really interested in buying a house, make sure you're current on your payments. Make sure you're current on your payments. Make sure your credit card payments are paid on time. Make sure your car payments paid on time. Make sure anything you owe to a bank that's going to report to your credit report is paid on time. That's the name of the game. Okay. Yeah, let's talk more about things that you shouldn't do, guys. What shouldn't you do if you're trying to get ready to buy a house? Let's talk about one of the things that pops up all the time. Do not run out and buy a brand new car. Do not run out and buy a brand new car. Sounds like a good idea. I know you want it. We all do. We all want a brand new car. We know better performance, clean, brand new, smells good, all the things, okay? We all want that. But I can tell you right now that I've watched probably hundreds of people not become homeowners because they wanted to be flashy on the street, and that car payment set them back, okay? Because here's how it works. There's something called debt to income ratio, okay? Your debts versus your income, okay? So let's just say that your income is $5,000 a month. 5,000, okay? Rule of thumb. We cut that income in half. Now, this is not exact. This is just rule of thumb, guys. I have to say that again. Rule of thumb. We cut that income in half. $2,500. Okay. That $2,500 is what can be used for your mortgage payment and all of your debts. Okay. So if you didn't have any debt and you didn't have a car, well, you can have as high as a $2,500 mortgage payment. That's pretty darn good. That's a house that you can buy. That's a house that you can afford. That's a house that you can get right now. But you started making, $60,000 a year. You used to make $40,000 a year because you had another job, but now you got a new job. Now you're making 60 G's a year. Yeah. That's some good money now. You start driving the streets, you're like, hey, I like that Lexus. Hey, I like that BMW. Hey, I like that Tesla, whatever you're looking for. Okay. Then you end up at a car dealership. And then you leave with a nice, beautiful car, $1,200 a month. $1,200 a month. And then you come to me and then you go, hey, I'm thinking about buying a house. And I'm like, cool, let's do it. You're like, I make 60 G's a year. And I'm like, all right, let's do it. Give me your documents, fill out your application. Let's pull your credit. Ooh. Did you just buy a car at the beginning of this month? Oh, yeah. I just bought a car. I started doing really well at work. I wanted to treat myself, so I bought a car. Okay, cool. Well, what you've effectively done is that $2,500 that you can use, you ate about half of that up. So instead of having a $2,500 mortgage payment, you can now only have a $1,200 mortgage payment. And that could be the difference of you owning a $150,000 house and potentially a $400,000 house. That's where it changes the game. Okay. Those aren't exact numbers, by the way, just giving you a good idea of what that does to stop people from becoming homeowners. Do not buy a house. Don't get your credit pulled. Don't go, to save 10% or 20% at Best Buy to get a credit card because you're going to be buying a house. Now, what happens when your credit gets pulled is you get what they call inquiries. Okay. People call them hard inquiries or whatever. They're inquiries. Someone has looked in to see your credit and put it back. So the inquiries show so that other lenders can see that people are looking at your credit, okay? Whether you took the debt or not, people are looking at your credit. So inquiries, for the most part, they don't affect your score, especially if you're the person who pulls their credit once a year, maybe twice a year. It's irrelevant. Doesn't mean anything. If you have bad credit and you're pulling your credit all over the place, trying to save 10% here, 20% there, yeah, it's going to destroy you. It's going to drag you down even more. Okay. It's kind of like having a full fridge and putting a bottle of water in there. Okay. So it's going to be too much and it's going to explode. In this case, it's going to tank. It's going to drop your credit scores. Okay. So if you are the person who has bad credit, yeah, probably don't want it pulled all the time. But if you're serious about buying a house, we're going to need to pull your credit. And I will give you some good news. I'm going to give you some good news about pulling your credit and inquiries. We can actually do something called a soft pull. Okay. A soft pull. What does that mean? That means that we can pull your credit without showing anyone that someone went in there and looked at it. And it's not going to show an inquiry on your credit. And you're safe. But we will be able to access 2 of the 3 bureaus. So right now, to buy a house, you access TransUnion, Experian, and Equifax. Okay. Instead of accessing all 3, we'll access 2. If we access 2, we're able to receive the debts that you have, the 2 scores that you have, because it's going to be 2 of the 3, and let you know exactly where you stand before pulling the trigger of pulling a full report. So there's the good news when it comes to that. Okay. Let's talk about something else you shouldn't do. Do not, and I repeat, do not change jobs. Can you? Yes. But I recommend you don't, because here's what could happen. So let's just say that you work at Tesla making $100,000 a year. And then you get a job at Microsoft where they're going to pay you $140,000 a year. And you're in contract. And you're literally buying the house. You've already picked it out. You're qualified. You went shopping, all that stuff. And you found the house. You said, this is what I want to buy the house for. The seller said, yeah, I'll sell it to you for that. You shook on it, signed documentation. It's in motion. And then you change jobs. Now, Is it a better situation that you're making $40,000 more a year? Yeah, it's a great situation. I want that for you. I want you to have that. Absolutely. But we might have to wait a few weeks more because we won't be able to close that loan until you receive your first paycheck stub. Ooh, ooh, ooh. Now, here's what happens when you join a new employer is that you hop in at an awkward time when they just did payroll. Okay, they just finished payroll, and let's say this is Monday, and they get paid on Friday. Okay, so you started on a Monday, they get paid on Friday. That's not your pay period. You're in a different pay period. Now you have to wait until the following pay period, which could be a month or 3 weeks from that point, and you're supposed to close next week. Ooh, that could be a problem. So don't change jobs, guys, at least not yet. Or advise with your loan officer first before you make those moves so that we can guide you properly to make sure there's not going to be a challenge in the closing. Because to be honest with you, as long as you disclose stuff to us, as long as you are communicating with us, there's a lot of things that we can help you with. We can make things work in those cases. And it's better to tell us because if we get blindsided by it, maybe you actually did make a move that we're not going to be able to repair. So know that. I hope that helps. Okay. So let's just recap, guys. Let's just recap a little bit. We're talking about buying houses. We're talking about your income, your assets, your credit. We're talking about what it takes to be able to buy a house when it comes to credit. No, the biggest deal is no lates, guys. Just be on time with your mortgages. Be on time with your payments. Be on time with your credit cards. Be on time with your cars. Be on time with all the little debts that you pay on a monthly basis. And don't overextend yourself, guys. I know things are tempting. I know you want that nice watch, that nice purse, that nice suit, those nice things. And I want you to have them. But it could be the difference between you owning a nice jacket and a house. And I'll be honest with you guys, the house is much warmer than the jacket. Much warmer. And much nicer too. Because you can't put friends and family in your jacket, but you can put friends and family in your house. And it's awesome to have them over for the holidays. It's awesome to have little get-togethers. Fight nights, birthdays, you name it. Owning a home is a fun thing to have. And it's awesome because it makes you money. It makes you money. It saves you money on taxes. So the two things that we love the most, pay less taxes, make more money. A house does that for you guys. It absolutely does do that for you. And I want to make sure you guys are on the right path to accomplish that. And that's why we're here today. So I will be here next Saturday, guys. So if you are watching this and you catch this on YouTube somewhere, every Saturday, 10 a.m., we're going to be hosting these live first-time home buyer webinars or just home buyer webinars because they're not just for first-time home buyers. I welcome everybody and anybody to hop in the chat, load it up with questions, comments, concerns about your exact scenario. We will answer them. We do this a lot on other platforms. We just started doing this on YouTube. We're doing about 30 minutes, so we're not going to be here for a long time, but we are going to be here long enough to give you insight, hopefully set you on the right path, give you the right direction, and give you our contact information in the event that you want to reach out and have a one-on-one. Some things are embarrassing. I get it. So if you want to just have a one-on-one consultation with us, feel free to hop on a call with us, or we can set up a time and day at our office. If you're local, we do help people across the nation, all 50 states, because our bank is licensed in all 50 states. But if you are local to us in Southern California, we would love to sit with you. It's not often that we get a chance to sit with our clients. It's very rare that we actually get that opportunity. Being honest, over the past 6 years, I've probably sat with 10% of the clients that I put into houses. The other 90% are done electronically because life is busy. We're working, we're on the freeways, we're on the move, we're on the go. We have no time to set up with our loan guy. We will talk to you over the phone and do it over the computer, but I'm okay with that, guys. So any route you want to go, I'm happy to accommodate. Thank you, Dohan. Thank you. You're welcome. Here to help everybody in 2026 become homeowners. Once again, if you have any questions, reach out. I'm going to put my phone number one more time. Give me a call, give me a text. I want to talk with you. I want to help you. I want to set you on the right path. All right, everybody. Have a great one. Talk to you soon.